Thank you for joining this Yellowstone Advisory webinar. Today's company presenting is Capita, and we're delighted to have with us Adolfo Hernandez, the Chief Executive Officer, and Stephanie Little, Deputy Director of Investor Relations, who will give an update on the performance following the publication of the FY23 results, which were released on the 6th of March. I'm now going to hand over to Adolfo to start today's presentation.
All right. Okay. Thanks, Steph. First of all, thanks everybody for being here today. Really appreciate the opportunity to interact with you on what we're doing at Capita, what we're trying to do with the platform, and initial thoughts since joining the company on the shareholder value creation and continuing the customer value creation that we've done. I know there's many questions that have come through. So we're going to try to do a quick run through with a summary of everything we talked about of the last couple of weeks since we talked about the 2023 results, just to make sure everybody's on the same information level set, and then we will go through the questions. So just a little bit of introduction about myself. So I'm now I think is now 9 weeks into the business. I joined on January 17th. Until January 16th, I was working for AWS, where I was responsible as a vice president for the global telecoms business. So there it's all about digital transformation of the global telco industry, working with the largest telcos around the world, arguably some of the largest companies on the planet, to really get that sort of digital transformation, migrate to the cloud, exit legacy, get productivity improvement, change management into sort of more agile, sort of cloud-friendly culture. And then prior to that, I've been half my career in sort of software, half my career in services, always in the boundary of how do you use technology to augment services, how to use services to get the last mile of a software deployment. In companies like IBM, Sun Microsystems, Alcatel-Lucent, been CEO of private equity-backed companies and of London-listed SDL as well. And I've worked across multiple sectors, customer sectors, private sector, public sector. And it sort of feels like this sort of 30-year journey for me. It's all been about learning all the skills and all the capabilities that will come very handy and will be critical in this new phase of Capita. So that's me. Super excited to be here. There's a lot of opportunity to unlock value. And I think that's probably the single biggest line that I would want everybody to remember. What we do delivers a lot of value for society, for our customers, for our employees. Unfortunately, it's not showing in the numbers. And the number one mission that I need to accomplish with the executive team is unlocking that great value of what we do and get it to translate into the numbers. But we will say more about that and some early observations and some early thinkings of what we're going to be doing. But Steph, maybe start with a quick rundown of the numbers, please.
Thank you very much. So I will just do a very quick run through of the numbers. I know many of you will have attended the full year results presentation, and obviously you want to hear from Adolfo. So I'll run through the numbers relatively quickly now, starting with the financial overview. I think key thing to note here is our results are in line with the trading update that we did in December, but I think we'd be the first to acknowledge that the financial performance is not where it needs to be. Our revenue, profit margin and free cash flow is lagging behind its peers. But if I pull out the main headlines from the results, we obviously finalised the 500 million portfolio disposal programme with completion of the sale of Ferra in January. We've significantly extended our funding maturity profile with the extension of our RCF and the 100 million of USPP notes in July of last year. We also reached agreement with the pension scheme trustees on the triennial review, and we've agreed no further deficit contributions from 2025, which obviously will help our cash flow in the future, which I will come back to. And then we've announced further cost savings from the wave that we announced in 2023 in November. So there will be a further 100 million of annualized cost savings by mid-2025, although we will be reinvesting some of that into the business for growth in the future. If I move us now onto the financial highlights page. So revenue growth was 1.3%, with marginal increase in public service and stronger growth in experience, albeit that division did benefit from a one-off commercial settlement in the first half of the year, which I'm sure everyone will know about. Our operating profit growth reflected the benefit from the commercial settlement, and then reduced variable pay in terms of kind of the management bonuses, which was then offset by contract losses across both divisions. PBT was impacted by the operating profit movements I've just run through, and then also by the increased financing costs and prior year, the non-recurrence of the prior year investment revaluation gains. Free cash flow was in line with our guidance in December at 115 million outflow, reflecting reduced operating cash flow, the cost associated with the cyber incident, and the increased capex as expected. Net debt was marginally up, which was in excess because our free cash flow was in excess of the net proceeds from disposals, which then was offset at a net debt level, including leases, by the reduction in our leased property footprint. I'm not going to talk through the divisions in detail, as I'm conscious that many of you will have attended the results presentation, but I think it's probably key that I run through the free cash flow bridge slide, which sets out the moving parts to get us to positive free cash flow in 2025. So the first thing to highlight on this slide is 2023 was impacted by a number of non-recurring outflows, which, as these do not recur in 2025, will improve the free cash flow going forwards. So we've plotted these out on the graph here. So the largest is the pension deficit contribution. Now, as I've just said, we've agreed with the trustees that there will be no further deficit contributions from 2025 onwards. There was also clearly the 20 million of cash associated with our cyber incident, which again will not repeat into 25. And then the furlough repayment that we made this year, which will not repeat into 25. Then finally, we've got the benefit from the cost reduction programme, which will see us return to positive free cash flow in 2025, all things being equal, as we see the benefit from there. If I just turn very quickly onto the outlook and guidance slide. So from a revenue perspective, we expect the group to be broadly in line with 2023. That will be driven by a mid-single-digit revenue reduction in experience, reflecting the continued attrition in our closed book life and pensions business, and then the non-repeat of the commercial settlement that we had in H1. Public service, we expect to grow mid-single-digit, reflecting some of the wins that we announced last year, including disabled students allowance and functional assessment services with the DWP. From an operating margin perspective, we expect a modest increase, reflecting the benefit from the cost reduction programs, which we've talked to. And then from a free cash outflow perspective, we expect that to improve from the 2023 position, but still be an outflow from the 70 to 90 million, which includes the 50 million of costs to achieve on the cost efficiency programme. Overall, that will then get you to an increase in net debt. That includes the FERA proceeds of 50 million, which we received in January, but clearly the free cash outflow is in excess of those proceeds, so we do expect net debt to increase. From a phasing perspective, we expect a revenue decline in H1 due to the H1 benefits in 23 that we've talked to, and then the growth from the wins as the contracts we've announced moved into their operational phases. Then from an operating margin perspective, we expect the margin to increase in H2 as we start to see the margin benefit from the cost savings that we have done in H1 coming through the margin into H2. Then we also finally expect cash flow to be heavily weighted from an outflow perspective to H1 as we incur the cash cost for the cost reduction programs which we've talked to. So there's a very whistle-stop tour of the finances, but I'll hand over to Adolfo to run through some of his slides.
Okay, thanks, Steph. Obviously, I don't want to take a lot of time here. I think obviously there's been the whole session that I did when we announced the results. but I just wanted to sort of take a little bit of time to sort of cover some of the key highlights. But let me be very clear with one thing. Obviously, these results are not what they should be. This company does a lot of good work. There is a lot of value locked in the company. These numbers don't tell the full story of what we do, or what our customers are telling me, what I see in terms of business processes that we are critical to. We just simply need to dramatically turn around the financial performance of this business, and that's where I'm focused on. I'm sort of preempting one of the questions that I saw came through this morning, which was, what are your first observations? Well, I think the first observation, and a big change from what I knew coming in, is I knew the customer relationships were good and strong, because everybody knows about how critical Capita is to the fabric of certain parts of society and the public sector, telecom companies, utilities. But actually, when you get inside and you get the opportunity to see that there's a lot more value locked in there than I initially appreciated. The counter of that is obviously the numbers are what the numbers are, and they're not what they need to be. And Steph just presented a sobering picture. It's improving, but it's not improving at the pace and the quantum that it needs to improve. So the number one thing that I should be held accountable to is our ability to get that value that exists today in what we do every day, what our colleagues are doing every day, and we translate it. Now, a few weeks in, I think it's 3 quick moves that we need to make that will, over time, produce a big part of the recovery. First one is that sort of simplification that will come through refocusing what we do, why we do it, where we do it, and most importantly, how we do it. Moving away from the traditional Capita, everything gets done on a project-by-project basis. Everything is done on one-off. The cost of innovation is borne by one contract alone. You make the mistakes once, but you really don't get a chance to replicate that much. To a more standardized, repeatable, efficient delivery type and thinking, where we actually will have standard solutions that we will take to market, and we will add the personalization and the last mile into that. And this is something that is very common in the market, and we just need to sort of get us from doing that just in a few places, as we do today, to that being the norm. That will have a big impact. And then the third one is our attitude to technology. I think as a traditional outsourcer, we probably have done more technology than other traditional outsourcers. But if I look at what our customers want us to do, they need help with the digital transformation of the key business processes that we manage. Right? It's not digital transformation in isolation. It's not tech modernization in isolation. It's not full re-engineering. It's just some key processes where we need to inject more technology, and technology that already exists, by the way. They just need to manage that technology and that outcome. And as a change and a departure from the traditional model, where it's not the technology that we have to create and we have to code from scratch. It's more about using platforms that exist today and common services that exist in the market. And this is the stuff that I was doing until I joined. And then just putting the Capita veneer around the business process expertise, the delivery, that outcome, and that trusted experience. I think all of these three things, the refocusing, simplification on how we operate and how we build and how we deliver, will unclog the system. I think will just give us a more agile way of working. We'll engage faster with our customers. We'll be more competitive in our cost base. We'll be more competitive with the quality of our offering, and it will get us to what I call the higher gross margin space. That if you combine that with cost takeout, will translate in improved financial performance at our level. So there is, some people might say, well, hang on a minute, we were doing transformation for 7 years. So what about this now? All I can say is I think what John had to deal with, it was more fundamental restructuring of the company, debt reduction from very difficult levels, very challenging, the work on the pension contributions that Steph alluded to. So the whole restructure of the balance sheet that was not insignificant, disposing of a number of companies to help with this simplification and sort of land in the positions where we are today. But that isn't enough, right? It's sort of get us to walk to that more digital future, these digital business processes that we can successfully deliver for our customers. It's my mandate now, and one that is starting now. And obviously, I own the past, but I get paid to focus on today and building out a future for this company to create successful outcomes for shareholders, for customers, and for employees over years to come. And I believe that gets us there. So we will do a Capital Markets Day in June, where we will be covering more of this in more detail. But I will just share very quickly some of the salient points of what you're likely to hear. So we talked about taking cost out and spending less in running the business. We're just simply spending too much today, and hence we've been decisive and taking additional action. And I addressed a number of the points of the non-standard to standard repeatable and standardization, etc. The digitization of offerings and what we do and how we do them. Number 3 is about leveraging technology partnerships like AWS, like Microsoft, like Salesforce, like ServiceNow, people who have built significant and really well advanced platforms with services that just need to be woven together to deliver an outcome rather than try to build everything ourselves. Again, it's a major departure. I think will give us agility, will give us scale, and both of those things, agility and scale, will just help us be more successful. And building on somebody else's proven scalable technology will also help us get it right the first time, and that's super important to keep nurturing the customer satisfaction and also to avoid the cost associated with not getting it right the first time. Which leads me to point number 4, delivery and precision. Very happy with the progress that has been made from managing a lot of the legacy contracts that were onerous, and that we sort of took a lot of time. A very difficult year, 2023, with a lot of distractions. Notwithstanding that, the teams will at least managed to deliver 90% of the SLAs, which good progress, good evolution. But I think we can and we should and we will be doing better in that area. And then maybe there are elements of the governance, or maybe not certainly there are elements of the governance today that is still a little bit stiff. It reflects a different era. It reflects a little different complexity, which is it's probably taking away speed and decision making. It has created a blurred picture of accountability and agility, and I need to get that back in the system. We will never be a cloud company. In full, we don't need to be a cloud company, but this is a lot of agility and a lot of best practices from the digital age, and having the smaller teams, clear accountabilities, clear empowerment, and good decision making, fit for purpose framework to optimize the way we work. There's also a lot of people keeping up the governance, so we can probably simplify that and just become more efficient. So you'll be hearing more about that, those sort of 5 key moves. We are well underway with a number of them. Some of them we're doing it with existing people, some of them we're doing it with new people that we brought in, and some of it we're getting third-party help, just to give us more bandwidth and more hands on deck to get us to move fast. So that's what we wanted to say sort of up front, share a little bit at the high level of looking backwards, but most important, looking forward. And then we can, if it's okay now, move over to Q&A.
I will stop sharing my screen, Alex, as we move into that.
Brilliant. Thank you very much. Well, sounds like you've got a very busy year ahead of you, Adolfo. So we'll look forward to seeing how things develop as the year goes on. We are now going to take questions. And again, if you've got a question, please type it into the Q&A box and we'll try and take as many questions as we can. So I think the first one is for you, Adolfo. In fact, the first couple are for you. Could you just tell us a bit more about why you actually joined Capita? You know, what are the elements of Capita are you most excited about?
Yeah, that's absolutely. And I will actually add a third one, which is, are you regretting joining Capita? And I'll take that one. It's like, no, absolutely not. And you know, it has been a rough 2023, and you could say, well, you know, I had plenty of opportunities to sort of change my mind. But not only I didn't, but I remained fully energized. And why did I do that? I've just spent the last few years helping other organizations to become more agile, to do more tech transformation, to move to the cloud, to use platform services at scale, to help them there. And I have observed that whether it's a government department or it's an international company in telecoms, or some of the downstream businesses who works with telecoms, they're all trying to do this, but they all need help, right? So you know, the technology is there. The technology to buy a, say, AWS Connect platform for telephony and analytics and all of that, and sort of building some capabilities to do Gen AI. Those basic core services are out there. Our customers are not all in a position to consume all of that technology and to keep track of it. They need help. They need somebody who's not going to come at it just purely from a technology perspective, but somebody who understands the business process that they're in, right? And is able to manage that complexity and deliver all the good value that comes from the new technology platforms to work in the particular business processes. And that is a really good opportunity for Capita, right? I can see this. I know how that works. I've done it before, and I know this is a good opportunity. There's ample demand, and I think being specialists as we are in some of the specific business processes that we have outsourced over the year, we have a great opportunity to do that. I also know how these hyperscalers work and how they work with companies like Capita, because I've just spent a few years doing that. So I think we will be able to intercept their go-to markets and align with them really well. So the opportunity is there. I talked earlier about the pivotal role that we play in society. And that means a lot to me, right? Every day, I, as a citizen, living here in West London with my family living in London, we all touch daily the work that Capita does, right? We do, and you know, whether it's in public transport or is my out-of-hours service of my council, or is council tax protection, or is when I take, you know, NHS services, or, you know, when I feel protected and by our forces, or I use our telecoms companies. So it's really important, I think, as a CEO to want to do well, but also wanting to do good for society. And I think that really moves me. I think this is a company worth unlocking value for. It will be a big impact. But I was most moved by the list of customers. You know, I tend to work from customers in. It's just my brain. It's always been my race, the way I've looked at the world. Certainly a lot more so after spending a stint at Amazon, where customer centricity and obsession is so critical. So I looked at the customers, the franchise. There is excellent. It hasn't always been smooth. It hasn't always been without challenges, but there's some relationships that go many years. Some of them, they go back decades. And customers who want the company to do well, that's a great position to be in, because all we got to do is do the right things, do it faster, do it more efficiently, get out of our own way, because we got customers really wanting us to do well. That's super important. And then I just felt there was a good alignment with the board, with the chairman coming in, a recognition that, yeah, this was going to be painful, but this was a necessary space, but this is how we get growth. You know, recognition, we have to sort of get leaner so that we can get stronger, so we can get better and we can grow for the next few years. So leadership alignment at the very top is super important. So I saw the opportunity to do well in the market. And I was excited to take it on, in spite that I know the starting point is very challenging.
And I guess the sort of a slightly sort of secondary question to that is, having been there 9 weeks, how does the reality actually compare to what your expectations were before you joined? Is it a bit better? Is it a bit worse? Can you give us some thoughts on that?
Yeah, the battery is better is the customer, because obviously when you're doing your due diligence, you sort of do the due diligence from the outside. Now that I'm on the inside and I have gone and, gone and met a number of permanent secretaries of the government, I've gone and met a number of CEOs from our top customers, and I've had the opportunity to hear from them about the criticality of what we do for them, and the strength of the partnership. And you're not hearing it from the IT ops director. I'm not hearing it from the marketing guy. I'm not hearing it from the guy who runs support. I'm hearing it from the board. That is really powerful, Alex. So that's been a very encouraging sign. If you ask me, what on the other side, I think the need for simplification, it's more acute than I was able to gauge from the outside. I mean, from the outside, I could just see, we're a $2.6 billion company that was spending 2.6 billion, generating 2.6 billion. So obviously that said there was something wrong. But I think obviously the simplification, the need to drive simplification, I cut through. It's consistently big. So that's probably my first two things. Actually, I would also say, even though you asked me for one, I'm actually positively surprised by the colleagues in the front lines in operations. The dexterity they show, the skills they have in their business process, whatever it is they're doing, it's utterly impressive. I've sat down in call centers, I've been listening in calls, I've been in training delivery programs, etc., etc. We're looking at back office operations, connections, disconnections. I've walked the floors. I'm really proud of what the guys out there. They feel their customer. That is super powerful. Now, people are a little bit tired. I'm very tired. It's been tough the last few years. But there is a good group of people that's like, okay, yeah, we'll do what it takes to get us to be successful. That's been a positive surprise as well.
Okay, thank you. Got a couple of questions here on the results themselves in sort of general. And the question first is, bearing in mind the year-end results which appear pretty awful and the market's negative reaction, how have you persuaded long-term institutional investors, many of whom invested around 40p or so, or who are losing 50% on their investments, to continue to hold their shares?
Alex, I have tried, and I think the team collectively, Steph, Helen, Tim Weller, our CFO, we took note and tried to be super transparent, right, with the opportunity and with the challenges. And the feedback we've received is that it's out there, right? I think we just said it, what it is. Hopefully people can sort of navigate through the numbers and make things work in their models. And there's been a reset, right? Because instead of saying, okay, well, it is, we just got to keep squeezing it one more year, and what we're saying is there's a lot of value here and it needs to be unlocked. Now that might not be for everybody, but I think honesty and sharing the size of the opportunity, and this is why it's worth doing. That's what we try to do. I think I like to say that anybody who believes that digital transformation is a space I go to, everybody who believes that a public sector and even the private sector needs help doing this, that this is a moment for incumbency to bring this as a shortcut to getting those improvements. You believe those macro theses, and this is a good space to be in. And today, we are being decisive. We are taking action. We've been transparent with the action. We're not taking a year to get the lay of the land. We're acting today. And I can only, Alex, just keep my head down today with my team. I'm making sure we maximize everything we do. We put all the right inputs, so down the line, we get the right outputs. It's very hard. If I try to sort of walk into the future, looking backwards to the past, I'll trick myself, right? So I'm laying out what I think it's there and it's immediate. We're not relying on any new thing that doesn't exist. We're not hoping new technology we're going to create. No, it's already there. We're going to leverage it. We've de-risked the business model by leveraging the most successful companies on the planet. And we're going to build out with a first-class set of customers. I think it's a really good proposition. Now, if you had I have a lot of empathy for people who've invested, but there's all I can do now is to build a platform and deliver a platform of success in the future, and that's where my energy is going to, and that's what the executive team is really behind.
Okay, thank you. As a new CEO, are you making these results as bad as possible so that you give yourself the best chance of showing some improvement during your tenure, or are these results just really poor?
But they are what they are. They're totally transparent. There isn't the proverbial kitchen sinking anywhere. We haven't come with anything. We haven't come with any surprise. We haven't written off anything. You know, everything is as it is. I think the team have done, the finance team, and they've done a good job at sort of presenting the numbers as they are. As you can see, there is nothing there. Yeah, I mean, the only thing is, you know, we talked about a bigger outflow of cash in 25 because we're taking immediate action on cost to drive simplification, right? So if you're looking at purely from a cash flow perspective, you would be like, okay, yeah, well, that's worse than it was. But it's not worse because, you know, it's worse because we're actually going to make the business more efficient, and we're going to use that as a compelling force to drive the simplification and the efficiency. But there isn't any kitchen sinking. There isn't any. It is what it is.
Okay, thank you. Got a sort of question asking about some specifics of your experience. Are you able to share a specific example of how technology strategic partnerships in your previous roles have enabled the business for success and the key measures of success?
Yeah, I mean, maybe I could just do one. It's in the public. So I'll give you two. I'll give first one that is public case you can go and read about, which is the work that AWS did with T-Mobile in the US, injecting this technology, particularly on call center automation and call center intelligence and predictive analysis of what callers could be doing and preparing and reconfiguring call scripts on the fly and doing sentiment analysis on the fly and meta tagging the calls on the fly and enabling that. So that's just technology there. Obviously, there was somebody who had to sort of deliver these technology, but technology is already there. And that's a public reference today. You know, another one that I was very closely when I was the CEO of SDL in I think it was about, when I go back like 2016. You know, we were presented with a similar thing where we had a business that was a services business and we had a software business, but what we didn't have was a software capability enabling the software business and the services business. So we put a lot of emphasis on developing this sort of services powered by software with workflow automation. We made significant advancements into machine translation. We're going back to 2016. We started to create our large language models, are so trendy in 24. We started putting those out, doing machine translation to pre-process work for translators. So the machine will do the heavy lifting and then the humans will do the enhancement. And, you know, you can look at these things at work. Obviously, it was value generative in SDL and its transaction to sell and merge with RWS. But if you look at, you know, what a lot of the value is today in RWS is linked with some of these capabilities and some of these platforms we put together. But now, you know, instead of having to take a leap of faith as we did in 2016, right now what we put in here is we're using these platforms that already exist. So I think that's way smarter than what I had to do in 2016, because the readiness of the technology is just advanced, right, by 7 or 8 years.
Okay, thank you. Got a couple of financial questions which I'm going to put to you here, Stephanie. The first one is around on the debt side of things. says, really disappointed to see the overall debt figure rise. Why was that? And I'll read the second question because it's sort of related, which is the net financial debt of 182 million seems worse than expected. Analyst consensus was only 156, and one analyst was as low as 117. What were the drivers behind the miss? And with all your disposals, what happened to the proceeds?
Yeah, that's absolutely fine. Also, I'd just like to correct one thing Adolfo said there about the free cash flow worsening in 25. It's actually worsening in 24 to be positive for 25.
Sorry. Yeah,
It's absolutely fine.
thank you.
What we're here for.
Yeah, no, good catch.
So in terms of the overall debt figure rising, so that was driven by the free cash outflow and the fact that the proceeds from some of the disposals were not received until 24. The main one in there being the Ferrer proceeds that were received in January 24. That also then leads into the consensus point. A lot of our analysts were actually modelling that the Ferrer proceeds would be received in 23 rather than 24, which is why you see the bit of the mismatch there. In terms of what the proceeds have been used for, they've been used to repay debt maturities over the years. So if you look at slide 14 in the pack, we have a liquidity chart which shows the previous PPM maturities, which peaked in 2022. A large value of the proceeds have been used for that, and then also funding the free cash outflow, including the pension deficit payments as they fell due.
Okay, thank you. And a reminder that deck is available on the IR section of the Capita website, isn't it?
Yeah, it is indeed.
Okay, so we had quite a few questions on the dividend and prospects for the dividend. This sort of question seems to encapsulate the thinking. So the last annual dividend in 2017 was greater than the current share price. When will dividends return? Dividends were recently signposted to return in the medium term. What does that mean? And when does Adolfo anticipate a dividend might be paid if things go well?
It's an excellent question, and to me, I love dividends, right? Personally, but we need to have the option, right, to do that. And you can't force a dividend when you can't afford it. So it is my intention that we are gonna become a more normal business, and that's what I'm committed to do, right? We're gonna grow. We're going to generate profits. We're going to make sure that the profits come back by cash generation. We're going to have happier customers, going to have happier employees, and we will have optionality, right, as to what we do with our profits, right? It's how do we use it? Is it for a dividend? Is it for something else? There's a lot of ways where we can do that optionality, and obviously we will look into that when we are there. I'm not opposed to it, but we need to get to that point where we have that optionality. We don't have it today.
Okay, thank you. Here's a good question that's come in today. What do you believe is a long run achievable revenue growth rate and operating margin?
Alex, we obviously nine weeks into this. I was 7 weeks on March 6th. We will come back on this on Capital Markets Day. We're doing the work as we speak. That's what we do in a Capital Markets Day relatively early in my tenure, because I know people want to understand the models for revenue, for profit. And yeah, I think everybody's sort of somewhat more clear on what 24 about how do we go after that. So I'm going to just ask people to please be patient. I want to make sure that we build a solid model and a solid business, and that we deliver on what we say. And I just need a little bit more time. So please hold until the Capital Markets event of June 13th.
Okay, thank you. We'll wait in anticipation for that. Again, a couple of questions here on the cyber incident. And I think really the questions are the cyber cost payments, have they come to an end, or could we expect any additional costs in 24, 25? And what are you doing to ensure that those incidents don't happen again?
So obviously on cyber, all hands are on deck. We have, and I am regularly spending a lot of time on it, particularly on the additional showing up at the fences. You know, in my time at AWS, I had the opportunity to help a lot of my customers, some of the world's largest telcos, who had cyber incidents, a lot of them actually in 2023, 22 and 23. So I think I understand the space reasonably well. So we're doing a lot of work there. We continue to do a lot of work there to keep improving our cyber maturity at all levels. This is kind of an arms race. As you can imagine, what do we have? How do we do it? Is the internal tools? What are the external tools we need? What are the processes? What is the change in the culture and the evolution? As any company in the planet is doing today, right? This is, I think probably what's different is this is a topic that is well understood. Here, I personally am very passionate, and I think Capita, having gone through it itself, right, has also done a lot of learnings. And every time these things happened, the most important thing is the learnings, is the prevention, is what can you learn, and how can you improve your game. And we are on that right now. In terms of exceptionals in 2024 and beyond, I mean, that for us is now sort of business as usual. We obviously keep investing in cyber and cyber defenses as we invest in facilities and we invest in other things. But no, it's sort of the exceptionals as far as we know today related with Capita are those in the 2023 numbers.
And I would just add to that in that the expense that we had was the 25 million, but only 20 million of cash incurred in 23, with the rest to be incurred in 24. So you will see a small amount through the cash flow this year.
Okay, brilliant. I think we've got time for one last question.
I was going to say, yeah, one more.
Interesting topic. It's on AI. And there are a couple of questions, so I'll loop into one, which is, what's your vision for AI and generative AI in Capita? And a linked question, I guess, is that, you know, the headcount is relatively high. Are you looking to utilize AI to reduce this and streamline the business?
I'm super excited about Gen AI. It's one of the topics that I've been the most fascinated about in my career, having spent a fair amount of time in the topic in my previous life. I only got more and more energized about it. I believe it will be, the impact of it will be great in business overall. I think it's going to give us everybody in business an ability to do more with less. Now, when I look at Capita, I think probably like many of my previous customers, right, there isn't a generic Gen AI platform that you deploy and it just sort of solves all of your problems. You know, Gen AI is very good for particular use cases, very targeted use cases. So you need large content ingestion in certain areas, right? Great. You can use natural language processing to sort of process this large amount of content, understand it, and then interrogate it, right? You may need on-the-fly calculations and predictions about what a person might be wanting at the other end, and you need that. Gen AI is great for that. You know, you might want to go and use it to create offers on the fly. Yeah, Gen AI is for that. But you end up having, I mean, I look at some of the Gen AI work that we are doing at Capita today, and some of the things we just already getting started as we speak. They are niches, right? They fit a particular business process in particular customer. We will end up building a catalog of what we call Gen AI based tools that we will use targeted in different areas, because there isn't this magical one. But each of them in isolation will give us productivity increases. So that will help us, obviously, you know, some of it is going to make us more competitive in the marketplace. Some of it will be more profit. And then some of the things that would allow us to do is just look at when we have to replace attrition, you know, how much of the attrition do we really need to replace, target it into pockets where we've taken advantage of Gen AI. I mean, this is a business that still hires, you know, north of 10,000 people a year. So maybe over time, that number goes down. But it's use case by use case. It's just, if anybody thinks you should buy a Gen AI tool and all of a sudden solves everything, no. They're very particular, very specific, but super powerful, right? And that's why I want to go and do this at scale, but very targeted.
Brilliant. Thank you very much, Adolfo, and thank you, Stephanie. I wonder, Adolfo, if you just want to say, I guess, a couple of concluding remarks before we bring this webinar to a conclusion.
So the financial performance is clearly not what it needs to be. Everything is explainable, but going forward, we are committed to improve this performance. There isn't a magic wand that we can use, but there is a plan, and it is a lower risk plan than what we were doing before. This is not about creating value in the marketplace that then we can translate into shareholder value. There is value already in the marketplace. It's a clear value with our customers that we need to unlock and just make sure that we give ourselves more optionality as a business and create more shareholder value. And that's the journey.
Brilliant. Well, thank you very much, both of you, for presenting today and engaging with these retail investors. And as you leave today's webinar, could I just remind you, there is a survey that we'll put up in front of you. It'll be really appreciated if you could just complete that. Yeah, we very much appreciate it. And to suffice to say, thank you again for attending, and we hope to see you soon. We've got 3 webinars next week. So it's going to be a busy week for us. And all details of those are on the Yellowstone Advisory website and on your screen now. So thank you again, and we hope to see you soon. Goodbye.
Thanks,
Thank you. Thanks.
Bye.